Good morning, ARMR Insiders. Good morning to all ARMR Report subscribers, everybody on YouTube. I want to thank all of you for your participation. We've had an unbelievable year this year. Been one of the best years on record for the ARMR Investing Way and the ARMR Virtual Hedge Fund. And so thanks go out to all ARMR partners who've been working diligently with me, working hard on our research desk all day, every day. The guys who've been adding ideas to the room, those of you who've been part of it all year. It's been really a wonderful experience, and I want to thank you guys for the effort you've been making on the desk. So we're going to dive into the last trading day of the year. We're going to talk about our risk monitor. This is the Algorithmic Risk Management Research Report. That's what this is, right? The ARMR report. So we're going to go over our algos and what it means for direction of the market and our portfolio. We'll go over our risk management rules of how we're going to execute at the end of the year here and into next year. And of course, we're going to highlight research on things like precious metals today. Got to talk about it. Silver, gold, the whole complex. We're going to talk about our highlighted group of the day, which has got to be energy. I touched on it yesterday. We bought 2 stocks yesterday, and I'll share with you what we were buying. So before I dive in, everybody, couple of thoughts. Number one, when you spend time with me on a morning meeting like this, I request you think of yourself as a portfolio manager on a hedge fund desk. So I'm going to share with you what I'm doing personally, information I'm sharing with investors, capital I'm managing for others. But at the end of the day, you got to figure out what your risk tolerance is. What are your goals? What are you trying to execute? And it's your job to execute that strategy. Only you could be the smart money of your assets. Okay. So, step one, let's go talk about the risk monitor and take a look at the indexes coming into the end of the year. So a couple of thoughts for you. Let's start with our most aggressive. Let's start with our most aggressive strategy, right? This is our swing strategy for trading the S&P. So on this desk, we day trade, we swing trade, and we invest. If you want to know, capital allocation, the majority of our assets are allocated to the investing side of our hedge fund. Okay. And we use our algorithms to swing trade and figure out when to commit the most amount of capital, both to swing trading, but also to our investing side, right? 8 out of 10 stocks follow the market. So the idea is to figure out market direction and then put on the investments. When you get both of those correct in the same direction, that's when you make the most amount of money. And that's also when stops work. If your entry point's wrong, stops won't protect your capital. You'll just get blown out of everything. So you got to get your entry point right. Marry that to the correct stop. That's how you manage risk. Okay. So we start with this strategy, triple the S&P. Every time we get a risk on entry point, we put capital to work, triple the S&P. Okay. That strategy up 188% in 37 months. That does not include treasury bill interest that we collect. So we're up more than that over 37 months. This is just pure trading profit. Okay. And you guys have watched me do this. I've shared with you every trade, every step of the way, going back to this first trade here in October of 2022. This is our first line of defense. This is our first strategy, most aggressive, very aggressive stops roll higher every 2 days. So the last entry point was here on the open on the 23rd. We literally bought the open on the 23rd. And so that was around 223 on this index, which is SPXL triple, right? And the stop right now has been rolled up just a tad to the low of 2 days ago, which is going to be 224.88. So step one, risk monitor is green. This strategy is long. The probabilities are that the market's going higher. We also know at the end of the year, start of the new year, 70% of the time the market goes up in this window. truth be told, right now the market's limping into the end of the year. So 30% of the time, market goes down at this time of the year, right? So we want to get on the right side of probabilities. We are, but we want to recognize the risks. In that 30% where the market sells off this week and next week, I've seen it be really ugly, like a trap door in the first couple of days of the new year. It's possible. So we have to follow our strategy, follow our stops, and execute. If the S&P is trading below, let's go to the S&P because that's what we use to trade this asset, is trading below the low of 2 days ago, which was Monday. So let's say 686. If the S&P at the end of the day is below 686, trade 28 will be done, which it might be depending on where the market's trading. Right now we're at a profit, so that'll be another profitable trade, albeit small. Depends on where it is. I mean, the market's getting hammered in the close. Maybe it's break-even trade. But anyway, if we're below 686 at the end of the day, we will be reducing exposure across the board. It would be against probabilities for that to happen. The risk monitor's green. Everything looks great. Right time of year. Market goes down anyway. Something's probably wrong. And so we're going to want to raise cash a little more aggressively than I might normally do it because I've been around for a long time and I've witnessed pretty ugly first weeks of the year. It's not supposed to be that way. So when the probabilities flip, right? When you see the market go the opposite way, it shocks some people and you get some pretty ugly selling the first week. So if the market rolls over today, this trade will be over. Below 686, the trade's over. Whatever it is, it'll be break even or plus a little bit, let's say. So that's easy. We take our index exposure and we reduce it. Risk monitor will still be green. I don't think there'll be anything happening today unless it's just a total collapse. There won't be anything happening today that would change the risk monitor from green. One day won't do it. But this trade, the canary in the coal mine, the most aggressive trade, will be out. And then what I'll do is, depending on what the close looks like, I'm going to cut positions down. Either I cut every position a quarter or a third just to raise some cash going into the new year, or I take out the weakest positions, stay with my strength, but whatever I consider to be the weakest positions, I take out. I don't know yet. We'll see what happens. So I'm just sharing with you what I may do to manage risk. This is the Algorithmic Risk Management Research Report, okay? So I think the market's going higher. Algos say the market's going higher. Time of year says the market's going higher. If stops are hit, we have to react and recognize something else is going on, okay? So end of day, we have to make those decisions. There could be a challenge of the stop in the morning. I won't do anything. So join me on the research desk probably around 3 o'clock. And from 3 to 4, we'll have to make these decisions on how to manage risk. Hopefully, we won't have to. Market will just go up. Things will be great. Okay? So we'll see. I suspect the markets will be higher today. So there should be a good carry trade, which is our day trading strategy for trading the S&P. So I may be in there increasing exposure to the S&P today. We'll have to see. Okay. So are we clear on that? We have max exposure and we have to manage that risk if the market's weak into the end of the year. And we have to do that because I've seen on more than one occasion in my life, when the market's weak on the 31st, it gets hammered in the first week of the year. So being defensive, not a bad idea. These are the indexes in our risk monitor, everything other than Bitcoin and treasuries. So we have 10 indexes, 8 of them are risk on. Bitcoin and treasuries are risk off. I still don't get the Bitcoin situation. And it makes me concerned about the market because Bitcoin's kind of the canary in the coal mine for me. So I'm waiting for Bitcoin here to rally. I almost want to get long in here. This is a bottoming wedge on Bitcoin right on top of support. This looks like the right location to be long. Breaks down, you're out. Breaks out, and you pick it off right near this key location under 90,000. We're at 88,000 and change, maybe 89,000 right now as I'm speaking. So I'm just looking for an algo buy trigger in here. I just don't get it. It keeps closing lower. You can see the bars don't look very good. And of course, there's this death cross. Now, the death cross doesn't really, stop the asset from going up. If it holds this location and breaks out, no one's going to care about the death cross. But if it breaks down from here, you'll hear everybody writing about how the 50-day crossed below the 200-day back here in early December, and it was a precursor to a collapse in Bitcoin. But, until it breaks, I lean bullish until it actually breaks down. So I'm looking to add that to the portfolio. Hey, let's talk about the highlighted group, what we added to the portfolio yesterday. Now, I talked about it yesterday in the morning meeting, and that is the energy space, okay? We're talking about energy stocks. These are the big cap ones, XLE, XOP. Those are the E&P stocks, U.S. E&P stocks. I like Gush. If I end up getting long, I'm going to get long twice the performance of XOP. So if I really step on the gas, I'm going long Gush. And if you remember, I can just go back and share this chart pattern with you. This, not pattern, but this chart with you. Okay, we're sitting around 2 standard deviations below energy sector weighting for fund managers. Okay, 2 standard deviations below the normal weighting for fund managers when it comes to the energy stocks. You could see that happened in 2020 in a pandemic. It happened in here around 2016. Each time that was the location to begin accumulating energy stocks. Every other commodity this year has gone through the roof. Oil and natural gas bouncing around the lows. (2026) prediction. There's going to be a wicked catch-up trade in traditional energy. That's my prediction. And I'm looking at it and I'm waiting for algo buy triggers. And I'm going to put capital to work when I see it. So I haven't done Gush yet. I haven't put a lot of capital there yet because I'm not getting the buy trigger, okay? But it's at the very top of my whiteboard. This is when I talk about, if you want to score goals, you have to go where the puck is going, not where the puck is, okay? And I think the puck is eventually going to get to the energy stocks. And I'm going to be standing there, right in the middle of the slot, banging in the rebound. That's what this is going to be, okay? But for now, what I've started doing in energy is using my dividend portfolio, so the ARMR dividend portfolio. Obviously, all I do there is buy stocks that pay dividends, okay? And in that portfolio, we already own AMLP. The pipelines are a no-brainer, 8% yield. We've owned them for a couple of years together. I would increase the size of AMLP if we ever close above $48 on AMLP, okay? So that's one thing I'm going to do. That's a pennant formation. If it breaks out into the green box, I add to it. But yesterday, what I added to the portfolio is ExxonMobil. Let's go look at ExxonMobil, all right? Let's go look at the weekly chart. So 3.5% yield. This is an enormous weekly base. You could see it. Okay, huge weekly base. If it could break back out and hit that pivot zone, I'm going to lock in a 3.5% yield, and my guess is my principal goes up a lot in 2026. And what's a lot on Exxon? I don't know, up 30%? Whenever I'm putting money to work in a dividend stock, I get 30% in principal and collect 3.5% yield, I win. But I think off of this base, it could go up a lot more than that, right? I mean, technical analysis suggests that when you break out of a base like this, to project how high the stock goes, you take the width of the base and turn it on its axis, right? So that could be a lot higher for Exxon. I also added shares of Canadian Natural Resources, CNQ, one of my old favorites. I want to thank Erez for bringing these to my attention and constantly talking about it throughout the second half of 2025. I've been taking my time on this story, but at the end of the year, I'm starting to build positions. CNQ is about to break that downtrend. It's in the pivot zone. That's the pattern I like. 4.5% yield. Go look at our Substack. We just dropped a fresh research report. ARMRinvesting.com. ARMRinvesting.substack.com. Free research that we share with all of you. If you're not already subscribed, make sure you subscribe. It's free. And that's where we share our research report so you can understand our thinking when it comes to our whiteboard or stocks that we're buying. I'm not going to go over CNQ. You can go read it and understand why fundamentally this is the right time to own Canadian Natural Resources. And if we see that shift of fund managers putting capital back into the energy space in 2026, I think Exxon and Canadian Natural will be two of the top names. So I have average position sizes on both now. If we start to see that breakout, if we get a risk on entry point on XOP, XLE, Gush, I'm going to double those positions and make them max in the dividend portfolio. But for right now, they're average position sizes. All right. Let's roll up this conversation with a discussion about precious metals. Okay, so we're looking at gold and silver right now. And I'm going to start the conversation by saying this to you. Monday morning, we found out that the commodity exchange, CME, increased margin requirements on silver 13%. The price of silver dropped 11% on that news. We come in this morning and we read again that the CME has increased margin requirements, this time 30%. How much do you think silver's down this morning? 13% on Monday, dropped 11%. 30% this morning, effective tonight. How much do you think silver's down right now? I know you all know what price of silver is. You get my point. Silver's down less than 4.5% right now. Down less than 4.5% right now. There's a total disconnect between the paper futures market and real physical prices. Let's explain why does the CME do this, and let's get rid of some of these conspiracy theories, okay? And you know, CME is trying to help the short and all this kind of baloney, okay? Let's just put that aside. The commodities exchange, it's very simple. When you, in case you don't know this, when it comes to owning futures, what are futures? Futures and options, right? But in the futures market, when you buy a contract, you're saying you're going to own that commodity in the future. You're going to pay for that commodity. Could be a bushel of corn, ounce of gold, silver, whatever. You're entering a contract where you're saying, I'm going to buy those ounces at some point in the future. You have to put up a certain amount of capital to prove you can actually buy it at that time in the future. Like the futures market is really originally designed for miners and farmers who wanted to fund their business, right? You're planting a lot of corn, a lot of bushels are going to come out. You want to be able to sell some of that corn in the future, get cash now, plant for the next season, whatever. That's the whole point of the futures market. And speculators come in and they never have an intention of actually taking delivery of a barrel of oil or a bushel of corn or an ounce of gold or silver. They don't really want to take delivery. They're speculators. They think the price will go up and they're going to buy the contract and sell the contract before they have to stand for delivery. But the way the mechanism works is it's a contract for delivery. So you have to put up a certain amount of margin proving you can take that delivery. When prices skyrocket and things are getting out of control, of course, there's the flip side, right? There's speculators who might be short. They don't have silver to deliver, right? It's a contract. They say they'll deliver. They've sold into the future, right? They've sold. Price goes up. If they don't have the bars to deliver, who's on the hook for that? Right? Mm-hmm. So it becomes a major problem. So what the commodities exchange does is they say to the guy who says, I'm going to deliver, but they don't know if it's a speculator or a producer. They say, okay, we'll put up more money and put up more money and put up more money, your margin, to make sure you can cover what you say you're going to do, right? So the whole purpose of jacking up margins is to get rid of speculators, because you don't want to get to the end of that contract, a whole bunch of speculators never had any bars to deliver, and then what? Force majeure. People are trying to figure out what to do with that position, and you have to close out the position for cash is what would eventually happen. So you got to force those guys to keep putting up margin to be able to meet their obligation or close their position. It's true on the sell side or the buy side, right? So if you have a lot of guys that are buying on margin like crazy and the price is going berserk and volatility goes berserk, the commodities exchange raises margins to make sure everybody's got the cash to deliver on the bets they're making. So a 30% hike effective tonight, you would expect silver to be getting destroyed right now, right? 13% hike Monday, down 11%. 30% hike, down less than 4.5%. There's so much misinformation flying around. You know, it's hard to really, I'm not even sure it's worth a lot of conversation. I'm going to tell you what I'm doing with all this information in a minute, because I'm going to simplify it for you. There's a simple way to execute, and I'm going to share that in a minute. I'm just going to execute this way. It doesn't matter what I think is going to happen. It doesn't matter what you're reading on X or YouTube videos you hear about guys that are talking about conspiracies. None of that should matter when it comes to managing your positions and managing risk. Have your strategy, execute that strategy, turn off the noise. So I'm going to go over that in a minute. Nothing of what I'm saying now will affect how I manage risk. So I thoroughly expect silver to be down a lot more by the end of the day. I'm surprised it's not yet. They raised margins on precious, on all the precious metals. Gold, they raised margins on platinum, palladium again. Gold is up right now. So if you're trying to understand why is that, how they're jacking up margins and prices aren't crashing and gold is actually up, how's that possible? Maybe gold's flat right now. It's flat to up. And I would submit to you from all the, I mean, I was up late last night going over all these things, trying to figure out what exactly is going on and try to share the morsels with you that matter. And the takeaway for me is if silver stays above the low of Monday. Okay, so let's blow it up here. We'll look at PSLV because that's our primary position. All right. I'm going to take that out because it was not a 3-bar reversal. This is not a 3-bar reversal. Okay, we talked about that yesterday. All right. So this is the price of silver. It blew out, it gapped down because of the margin increase, ran right back to the highs. Now a 30% increase, down about 4.5%. If silver stays above the low of Monday, which will be 2340 on PSLV, and on SLV, it's going to be right there at call it 2392. So if you're raising margin requirements and the price doesn't go below the low of Monday, the takeaway is the takeaway has to be that the speculators don't have such a massive margin position on as people think. That has to be the takeaway. Raising margin requirements isn't killing the stock, the asset price. The only reason for that is, I guess a lot of people want to stand for delivery. They're not just speculators. They have deep pockets. I don't know. We have to see where it ends today. It could crash between now and the end of the day. I don't know. It would be surprising to me if the price stays above the low of Monday. I think it's fair to say that if the price stays above the below of Monday, it's wildly bullish. I think the takeaway would be we are shifting to, there's a disconnect between physical prices, which are higher, and cash prices, which are being manipulated by these types of margin increases. And eventually what you'll get is a margin increase to the point where cash and futures markets start trading together. There won't be the disconnect. They'll be trading in line. I don't know. Part of this has to do with China closing the doors January 1 on their silver exports. There's so much news out there and noise. Let's go over how to manage risk. Okay. I talked about it yesterday. I cut a short for everybody to see it on the YouTube channel. Okay. It's really simple to me. There's 3 stop locations that I'll be using. Hey, look, if it's too hot in the kitchen, if you can't stand it, if it's driving you crazy, then your position size is too big and you should cut your positions down wherever so that you can make decisions based on a strategy instead of based on whoever you happen to see or read on X or hear on YouTube. Okay? Market's opening right now. I'm going to have to go. That was the bell. The stops are simple. If we're below the low of Monday, I reduce exposure to my metals. Okay? I'll probably reduce some during the day. And if we close below the Monday, I'll reduce more at the end of the day. The second stop is the 25-day moving average, and the last stop is the 50. I'll have a core position down to the 50. I've got max position on now. We close below the low of Monday. Even if we go below the low of Monday, I probably cut it down. Close below, I cut it down some more. By the time we get below the 25-day, I'll have taken off the majority of my position, booking massive gains, carrying a core. That's my strategy. It'll apply to all my precious metals positions. Okay? And I step away and I stop caring about what the noise is. Those are my thoughts for you on the last trading day of the year. I hope you all have a wonderful New Year's. I can't wait to see you in the new year, right? Tomorrow the market's closed. Don't forget about that. I look forward to working with all ARMR Insiders on the research desk in a minute. We'll get the live stream going all day. ARMR Report subscribers, you're on your own. I wish you a wonderful New Year's. Anybody else? Hey, consider joining us on the desk. Become an ARMR Insider. Become an ARMR Report subscriber. It's a new year. It's time for you to start making money. All right? Take a look at armorinvesting.com if you'd like to do that, if you think we're the right fit. Everybody, thanks for spending all the time you've spent with me in 2025. It was so much fun. Happy New Year, guys.